All right, Stephen, you want to go ahead and get started?
Yeah, I think we have a critical mass here. Let me say good afternoon to everyone out there, and good morning to our Pacific Coast colleagues. We hope everyone's having a great day, and I know here in Denver we're smiling just because the snow has finally stopped, and even though it's May 2nd, we still have some on the ground. So hope that enough puts us in a good mood, and I hope everyone out there is having a great week as well. My name is Stephen Fleming. I'm a vice president here at Phoenix Capital. And on behalf of Richie May and ourselves, I'd like to thank everyone for joining us today and welcome you to the Mortgage Servicing Rights Asset Management webinar. We're going to focus on best practices and the invaluable perspective of auditors as well. This is actually the 2.0 version, if you will, of this presentation. We originally gave it at last year's November's Mortgage Banking Association Accounting and Finance Conference in San Diego. And so we're excited to present the new and improved version, or edition, if you will, this time around. We've been working a lot offline to make sure that everything is salient and relevant, given the market's always changing out there. Let's start with a bit of housekeeping. The webinar is being recorded, and it will be made available afterwards. So feel free to email either of the speakers here if you'd like the presentation or how to find that. I believe it will also be made available on Richie May's website as well. So, by all means, check that out or just follow up with us afterwards, and we'll make sure you get what you need. And although we currently have all lines muted, we'd nonetheless like to make this as conversational as possible. So what I suggest is feel free to use the webinar's enabled questions, which is you can submit them via typing them in on the webinar software, and we'll do our best to address those in real time. And we have about 6 to, I guess now, a little bit less than 60 minutes together. There's a lot to cover, so we'll do our best to do so expediently, and also to save some time for questions at the end if we're able to, and then we'll simply take all the lines off of mute and make sure we address any questions then. And as always, our speakers today are gracious enough to, volunteered to follow up with any other questions as they arise afterwards if time doesn't permit to address them now, or if you simply think of a question as you're rereading this deck on Friday night, with a glass of wine. So now, I'll take a second to introduce the firms and the speakers. The first speaker is Seth Sprague here at Phoenix Capital. So for those of you who don't know Phoenix Capital, we were founded in '96. We're a mortgage banking advisor, but we specialize in mortgage servicing rights. You kind of think of us as we have 2 lungs to our organization. On the first side, and we're very small, so we wear a lot of hats, but on the first side, I'd say, is the capital trading side, where we have managed many deals since our inception. I'd say over the last 12 months, we managed and closed about $400 billion in MSR trades, and that spans bulk and flow, new production, old production, seasoned, performing, and non-performing as well. And of course, across Fannie, Freddie, Ginnie, and private label. And then the second aspect of us is our analytics arm, where we do the valuation, best X, accounting management, and other related analyses for roughly 175, 200 clients all in. And so Seth joined us actually very recently, so we're excited to have him here, and he's part of why this is our 2.0 presentation. Seth's been just joined us within the past month, but he comes to us after more than 10 years with SunTrust in Richmond, managing their entire mortgage servicing rights portfolio. So that's including the valuation processes and any periodic MSR transactions as well. He has a total of over 17 years in mortgage banking, and before SunTrust, used to call Bank of America, United Financial, and KPMG home. He's also a frequent speaker with the MBA School of Mortgage Banking, so perhaps you've sat in one of his classes before, and if so, don't hold that against him.
Exactly. There'll be no jokes.
We thought Seth's participation here would be pretty invaluable because he sort of where he sat at SunTrust over the past 10 years, he had to do this on a day in, day out basis, including taking SunTrust from low con to fair value, from unhedged to hedged. He implemented new models, SOX compliance, the federally mandated stress tests, and kind of was a resident Basel III advisor as well. So happy to have Seth here today. And then we also, of course, have Keith May, who is one of the partners at Richie May. Richie May, as I think everyone here knows, specializes in serving the mortgage industry. We've been doing that for over 20 years, and we've worked with them for a long time, and they're one of the preeminent auditing firms out there. They have over 100 mortgage banking clients, and I think they've certainly established themselves as a national leader in these type of services, which cover the financial service firms, but not just the banks, including hedge funds, broker-dealers, and other asset-based lenders. And Keith specifically is an audit partner for Richie May. He's been in public accounting for over 30 years and specifically specializing in mortgage banking for the past 20. And I think as is evident by his presence today, Keith is a frequent speaker and panelist on a variety of MBA and other types of industry events, so we're privileged to have Keith here with us too. With that, then I'll just jump into the agenda. There's a full agenda, so we're going to proceed, try to proceed as efficiently as possible. But we're going to cover off on beyond just setting the stage initially, which I'll do, and then I'll pass it on to Seth and to Keith. We're also going to discuss the valuation, capitalization, accounting of the MSR asset. We're going to touch on some key business factors, hedging, cash flow, capital, net worth, et cetera, and then round out with a variety of other miscellaneous ones, including some regulatory aspects. We've deliberately selected these topics to be as comprehensive as possible. And some subjects, of course, deserve far greater time than what we're able to allocate today. So again, by all means, feel free to follow up afterwards if you'd like any more color or detail. So I think with that, then we'll jump right into set the backdrop and then into that next slide, Keith, if we can. The one constant, I guess, like people say, is change, and that's certainly applicable in our industry. When we gave this presentation in November, I would say there are still some similarities with that, but I guess as ever evolving as our industry is, the context is changing slightly as well. On the whole, those correspondent buyers who have backed off of the servicing bid or backed off from the market, that's still there. But yet some recently have sharpened their levels, and I'm thinking of Wells on a case-by-case basis. There are others out there who have also seemingly sharpened their pencils. But it's difficult to really get a pulse on that and its stability, especially with Basel III around the corner affecting some of these AOT bids. So it's very difficult to get a reliable, sustainable pulse on that. But we have new buy-side, new sell-side entrants in the servicing market, so it's changing the value, it's changing the blend of what we're seeing there every day. The flow servicing, which is something that just about dried up entirely, and by flow servicing I mean having a new outlet out there for your current production in a forward contract basis. Think of it just like a co-issue structure, where that's now coming back with some strong buy-side demand supporting it. And then last but not least, I'll just say that the best execution analyses, they certainly require that great focus on the buy side, on the sell side, but also the retention of the asset, which is, I think, why a lot of us are here today. If nothing else, the conversation that we have fairly regularly is that, hey Phoenix Capital, hey Richie May, MSRs used to constitute 5% of my net worth, and now they comprise 50%. Well, what should I do? What are best practices? I know I have those Fannie Mae delivery caps as a function of my net worth. Freddie Mac is also rolling out theirs. My bank warehouse lines are a function of net worth, and I want to make sure that I critically understand this now very key asset on my balance sheet. And last but not least, I think because of the above, then this Keith and Seth and I and our firms collectively believe that this has never been more critical to understand the servicing rights asset, just given those far-reaching and far-impacting implications. We're going to talk quite a bit about what those are, and we hope to shed light on a lot of that today. And then the last update that I'll jump on before passing the ball off is, everybody likes the table and a graph, so I made sure we had at least one of those in there. And this is to give almost like a snapshot of, you can see as the graph roller coasters downhill, and then just began picking up over, say, it's called the second half of last year into this last closed quarter, that this is the flow pricing captured here, which is really, I think, all we have to say is that it seems that as independent mortgage bankers and as lenders out there, we now have another outlet that is growing, and we would suggest arguably the most competitive true net, I want to emphasize the net SRP bid out there that, can impart price certainty over a future period, and it could certainly be invaluable to the business models. And this has been a new development, and because of this, I think it's impacting how we're looking at the MSR asset itself from, if I cannot hold everything but I cannot sell everything, it's going to be some blend in between. So for that which we're selling, what Phoenix is seeing out there on the market and trading this every day is that this new flow resurgent option is becoming oftentimes the best X scenario for a lot of our clients, and is therefore impacting what we're retaining, and then how should we view that retention strategy going forward. So it's certainly evident of what we've been seeing. So I think with that, let me then formally just pass it off to Seth, who's going to start us off with the meat of the presentation into valuation.
Okay, can we advance slides to slide 8? And we'll start here with the 3 flavors of ice cream of MSR values as we know them today. And this, I could literally spend the next 3 hours talking about this one slide, so I'll do my best to be brief. But, fair value is pretty much defined by the accounting literature for MSRs. And when it's an inactive market or there's unobservable inputs, MSRs become a level 3 asset, meaning that they're assumption driven. And we'll spend a good chunk of the rest of my time talking about assumptions and validation of assumptions. But MSRs are typically a fair value asset, level 3. Another flavor of ice cream, which is my personal favorite flavor of ice cream, is economic value. And this is the value that is actually ascribed to each individual company. And one of the main reasons why I came and joined the firm like Phoenix Capital is to help people understand their economic value and sort of the true cash flows and earnings of this asset. And so this would be using your own sort of cost, ancillary. If you're in a subservicing arrangement, you'd be using specifics from a subservicing transaction would be applied here. And there could be a very wide variance between fair value and economic value. The final value is the market value. And that's where it could sell today. And as I think they've talked about in the last presentation and this presentation, the market ebbs and flows. So that the market value, there isn't always a consistent takeout. I would argue today that there is a much more consistent and a higher level of takeout than there has been. But market is market. And what we were trying to do as an industry is drive ourselves, I would say, towards this economic and fair value concept. If we turn the page, let's talk a little bit about the disparity between market and economic value. And I think there's some key factors here that we need to address in a little bit more detail. One, as everyone who's in the mortgage space knows today, mortgage rates are on their historic lows. And as I joke with people, this is the 4th year that they're in their historic lows. And so every time we test these lows, in past lives when I was sitting at SunTrust, we were like, wow, we just put on 5% mortgages. We'll never see rates this low again until next year when they became 4.5, then 4, then 3.5. So the difference between kind of economic and market value is driven by historically low interest rates and then, more importantly, the ability of borrowers today to prepay. As an industry, there's been tremendous consolidation, not only on the origination side, but also on the product side, which has led some borrowers who just simply cannot refinance. And in order to address that, there's been some government programs such as HARP, which have come to fruition, which allow borrowers that have higher than traditionally allowed LTVs to refinance, which is 80%. And HARP allows people even with LTVs above 100% to refinance. That production is going to have different prepayment characteristics. It's going to have different cash flows. It may have different default characteristics than traditionally underwritten less than 80 LTV Fannie and Freddie servicing. So it's always important to understand what type of servicing you're in and your economics around that type of servicing. There has been, continues to be, opportunities between supply and demand imbalance for servicing rights. I would argue that the demand for servicing rights today is probably the highest I've seen it in my 17 years in mortgage banking, and that is purely a function of prepayment speeds and rates. Defaults prospectively should be better. The originations today are higher standards, but one of the issues that we face talking to large banks is the difference between past sins of credit and future sins of credit, and that banks are unwilling to, in essence, deploy more capital to MSRs at this point because of what we've learned over the last 4 years. This creates tremendous opportunity for new entrants to enter the servicing market, and I would say very attractive pricing and very attractive yields. If we go to the next slide, from a fair value and market value perspective, anytime that there's inactive markets in the servicing space, that sort of leads us back to our level 3 assumptions or our fair value level 3 asset, i.e. reliance on discounted cash flow models. Anytime that there's models, we need to talk about the use of assumptions and and what we should do with those assumptions. And I would joke when I teach for the MBA that I literally had a package at SunTrust that was 150 pages of assumptions every month. Mind you, I was a top 10 bank, so I had a big servicing portfolio, and I would literally have a 50-page packet every month of my assumptions with sign-offs. I would put a big, heavy binder clip on it, and I called it my auditor go away package. And so when I'd come see them down the hallway, I'd try to throw it at them and then run the other way screaming. But, I mean, documentation, documentation, documentation. So regardless of what model you're using, what evaluation firm, there is significant pitfalls that you need to avoid when running valuations. Having unsupported or inappropriate assumptions, frequent changing of assumption methodology is probably the one that will get you in the most trouble. It's not the frequency of changing an assumption, but it's the changing of the methodology. So what is the process that the assumption is using? It's one thing to have interest rates changing every day in your model because interest rates do change every day. That would be acceptable. What wouldn't be acceptable is using a different index. One day using a Treasury index, one day using a LIBOR index, one day using a gold bullion index. That would get you in a lot of trouble. So you want to make sure that your assumptions are documented, that they are comparable to market data. Make sure you have segregation of duties between your valuation, accounting, and hedging functions. Have access to actual versus modeled performance. Policies and procedures are critical. And then making sure that you've got coordination within your companies between the various functions of secondary, accounting, finance, potentially, market risk, treasury, and make sure everyone's integrated into the MSR discussion. One of the key points to take away from the slide is even if your mortgage servicing right assets aren't material to your balance sheet today, they can be in the future. And so you want to get, as we would refer to it, that cadence of reporting and that cadence of understanding within your company. If we go to the next slide, MSR valuation process and what are the best practices, certainly having a consistent set of assumptions and models is critical. The one exception that we would note is that from a capitalization perspective, which is the initial recording of this asset, it may be appropriate in some cases to have a slightly higher discount rate than for capitalization purposes than you might use for your normal level 3 fair value discussion. The interest rate on the MSR should be evaluated with the context of the overall company. One, you're willing to exposure to the MSR asset, and two, is the yield adequate? If the yield on the MSR asset is not adequate to meet corporate hurdle rates, IRR calculations, there's a couple options. One is selling the MSR asset outright. I would highly recommend using a firm like King's Capital for that. The other is you might want to hedge your MSR asset. Hedging implies a cost. And so you want to be very careful with your hedge program, and we'll have a couple of slides later on the hedge process. But you want to make sure that whatever hedge instruments you're using closely match the profile of the MSR asset that you're generating. And there's going to be very few instruments that exactly match hedging. So if you're going to enter into a hedging program, one of the things you need to be cognizant of is that there may be some slippage to the P&L. And that is better communicated up front in the process than as a surprise. And I could give you many stories of that in my tenure at SunTrust. Having taken them from a non-hedging low-com shop, lower cost of market shop, to a fair value hedging shop. Data. I fortunately chose to leave SunTrust Mortgage, but as I would joke with my staff constantly, I will be fired one day for our data. Mortgage companies are sort of notorious for having data issues, to put it nicely. And so you want to make sure that you've got the correct data that you're going to hedge, which would include servicing fee, investor types, correct float on your P&I and T&Is. Any valuation process should be viewed in conjunction with like a secondary marketing pipeline as well, potentially, because as the servicing value moves from the pipeline to the MSR, there needs to be a clean transfer of the asset. There also needs to be clean pricing of that asset when the loan is in the pipeline for servicing, even though accounting would say there's no MSR. An industry practice would argue that there is risk there that you need to account for and make sure you've got a clean handoff. As far as models, value and assumptions, you know, Phoenix believes, and I believe too, that there's probably 3 industry-recognized models out there that they would use, and they would be Compass Analytics, which is currently used here at Phoenix Capital, QRM, which is a model I used at SunTrust Mortgage, and then MIAC is a third sort of industry model out there. They're licensed. They may offer you the ability to, they may host the application for you so that you don't have to invest in the servers. You just have to invest in the licensing. Some of them require you to invest in the hardware as well. You should pick a model that not only meets your needs today, but meets your needs in the future. And for anyone who has been involved in stress testing process, I would put a big plug-in for QRM, actually, because their planning and forecasting module was used by SunTrust to answer all the Fed stress test questions. And that was a big help in demonstrating to the Fed about the completeness of the MSR asset. Key point here, it's bolded. I even highlighted it on my page, but a valuation model is only as good as the assumptions. And as someone who's valuing mortgage servicing rights, whether you're using an outside company or doing it internally, you need to make sure that those assumptions are verified through either surveys or independent valuations, and you need to keep them updated. Prepayment speeds are going to change radically based on changes in interest rates. You want to make sure, and we've just highlighted a few here, delinquency curves are important. You may want to segregate your population. New production is going to have a different delinquency profile than seasoned 2007 vintage. Cost of service is very important. Discount rate, pre-tax discount rate is important. Escrow earnings rate I would add on this list. And then ancillary income would be the final sort of key 6 assumptions that you would want to make sure that you have good data for. And I'll put the plug in earlier to steal from a later slide. You do want to do modeling where you get the cash flows out and compare them to your actual results at some point as well. That, in record time, is the MSR valuation process. As I said, at the MBA, that usually takes me 3 hours to go through that. But that's the valuation process. Let's dive a little bit deeper into the capitalization, which is the recording of the asset initially on the balance sheet. So if we go to slide 14, you know, OMSRs are created, or MSRs are created at settlement date, and the same model and assumptions, with the possible caveat of maybe slightly higher discount rate, should be used for the capitalization process. You know, there's other solutions than running a model every day as well here. If it becomes cost prohibitive or resource prohibited to run this on a monthly basis, a grid approach could be used. And that's something that we could probably have conversations with offline with people that would be interested in hearing about the grid process. But that's something that we offer as a service of people for different products, different vintages. Here's a grid that you could use for capitalization. But the data from the initial capitalization should be closely linked to secondary marketing, because those are the folks that know what's coming over to you as an MSR valuation manager. And that data should be reconciled to the servicing system. Capitalization rates should be analyzed just as the overall valuation should be analyzed, I would suggest on a monthly basis. And excess servicing fees. You know, most mortgage bankers are going to run some sort of best execution in their secondary marketing, but as an excess investor, and this is where you're taking a servicing higher than contractual minimum servicing fee, in the case of Fannie and Freddie above 25 basis points, you need to understand that the economics of the excess are different than the core 25 contractual minimum, and just make sure that that's consistent with your overall sort of business strategy and objectives. There's time and place to add excess, there's time and place to shed excess, and it depends on different markets. As I said, if companies don't have the experience to model, one option is to outsource not only the valuation but also the accounting function. Phoenix Capital does this for a number of players, and it's fairly typical to see a new entrant in the MSR portfolio hire somebody like a Phoenix Capital to run it for a period of time, and then they may transition it to in-house, continuing to use Phoenix as that backstop or that calibration process to assumptions and values. In fact, at SunTrust, we did all our work in-house. We actually ran daily valuations, but we used Phoenix Capital every quarter to provide us an independent source of our value and assumptions. One of the things on a capitalization grid to consider is the state grouping. You know, states are going to perform differently, and on the next page we'll take a look at that in a little bit more detail. Capitalization rates should be used for best execution, but they should also sort of try to reflect your economics. And that gets into a tricky situation when you're talking the secondary about agency buy-up and buy-down grids for excess versus where the servicing market will trade. And we're all aware of recent, let's just say, disparaging or desperate values offered in those two places. If we go to the next page, this is probably my favorite slide of the presentation. I literally could spend the rest of the day talking about this, but this is for illustrative purposes only. But there's so much valuable information on this slide. I'm going to pause here and actually give you some numbers to try to quantify sort of value change and set you up for a hedge discussion. But initially, what we're going to talk about here is that there's different tiering or different state breakouts. You can see in the box, sort of the top left quadrant, there's 7 tiers broken out here, with Tier 1 offering the highest pricing and Tier 7 offering the lowest pricing. That can be a function of a variety of factors. The most important is probably going to be prepayment speeds. But one would argue today, and we were exploring this at SunTrust when I left, foreclosure timelines are important. Is it a judicial or non-judicial foreclosure state? Escrows. What is the frequency of the remittance of the escrows? Does that state require you to pay interest on escrows or not pay interest on escrows? All that should be factored into how you determine what a good number of grids or tiers are. I would say industry average, if you're not using an individual state SRP, something in the 5 to 7 range is probably appropriate and gets you close enough to what you need. As you kind of continue down that left-hand side, you can see a Fannie Mae actual ad, and then you can see some deducts. Based on the remittance characteristics, actual or MBS may be worth more or less at different periods of time because they offer different floats. In fact, actual offers 0 float, but you don't have to advance, so that's advantageous at times. And then the other reason why you see different terms there is because terms drive, 1, different prepayment behavior, but 2, they drive also different potential escrow balances and P&I amounts. LTV, HARP adjustments, you can see there, again, illustrative in nature. What we're attempting to take into account there is slightly higher default risk. One could argue that actually the industry at times has paid up tremendously for HARPs because they have less of a prepayment characteristic. The next box, what I want to talk about is the rate index shock, and I'm only going to cover the Fannie Mae 30-year one. We've got a similar one below it. But if everyone can look on the slide and you can see a par rate that's got 0 basis points and then you go rates go down 100 basis points, which is in this illustration, it's 100 up 100 or plus 100, and you can see a minus 31 basis points in value. To give people some perspective as to value change and why you might want to consider hedging this portfolio, is I simply took a $500 million notional portfolio. So that's you're servicing $500 million of product. And if the value was 80 basis points, so the net present value of all the assumptions was 80 basis points, that portfolio would have a fair market value of $4 million. If rates were to move that 100 basis points down, and this had rate incentive now of 100 basis points or plus 100, it would lose 31 basis points of value or $1.55 million. That is a $500 million portfolio. At SunTrust, I managed a portfolio that had a notional balance at its peak of $150 billion, and when I left, somewhere in the $125 billion range. So you can imagine at a company like SunTrust what a 100 basis point down rate shock scenario might have as a value change. I would think $1.55 million loss would attract some attention on a balance sheet and certainly an income statement. And let's talk about the up scenario, because we don't want to be always pessimistic. If rates went up 100 basis points, this portfolio would gain 18 basis points of value, or $900,000. You can see there's a slight disparity between the value lost, that's down 100 versus up 100. That's called negative convexity of the MSR asset, which is another reason why we want to hedge this thing. Now, I know everyone's saying, okay, Seth, you're being awfully dramatic on a Thursday afternoon. 100 basis point rate shock isn't going to occur on my $500 million portfolio. So let's just talk about a 25 basis point move. That would be 8 basis points in value, and that would only be $400,000. Okay? So you can see, again, even for a small rate change, and in my 17 years, I've experienced numerous days where it's moved 25 basis points. It's not a black swan event. It's happens several times a year. That would get the attention of senior management, and that's one of the reasons why you'd want to hedge this asset. With that, I think I've taken my allotted time on these two slides. We're going to turn it over to our friends here, and they're going to talk about the accounting.
Okay, thanks, Seth. This is Keith. So I'm going to run through some accounting and tax concepts for the next couple minutes. So the accounting concepts are coming out of the FASB codification, Section 860 on transfers and servicing. So, if you're looking for a technical question, that's where you want to go to. So, some important concepts. The MSR only becomes a distinct asset for financial reporting purposes when you actually sell the loan and retain the servicing. So I know Seth talked about, that SRP value is sitting there in the loan pipeline and your loan held for sale, and you need to hedge it. But from an accounting standpoint, you don't actually bifurcate the MSR asset and record it separately until you actually sell the loan and retain the servicing. And as Seth said, you're going to capitalize that MSR value initially at fair value, which is really an accounting concept. Accounting for MSR is distinct from the accounting for loans held for sale, so you don't have to have conformity there. You can have your loans held for sale being recorded at fair value under the fair value option and do your MSRs at lower cost per market. Or you can have them both on fair value, or you can have your loans held for sale on low com and your MSR at fair value. So you don't have to conform those two, and that's a misconception that we run into once in a while. The MSR can be an asset or a liability. Depending on what's happening, it could flip from an asset to a liability or vice versa. If circumstances change, at least on a sort of loan level basis, it could, depending on what's going on with the servicing on that loan, could flip from being valuable to being a liability for you. So, so the downside risk is not zero. It can go below zero, where you have a negative value on an individual basis. The initial value could possibly be zero, and that would happen if your benefits exactly equal adequate compensation, and there's not really any profit margin in there. So you could have a day one value of 0, which is probably be unusual, but then day 2 you probably have either a positive value or a negative value, depending on what happened to interest rates and your other input assumptions on day 2. You report servicing liabilities separate from servicing assets. And then as Seth said, MSRs are level 3 in the fair value hierarchy, and that has some ramifications from a financial reporting standpoint. So there's some additional disclosure requirements you're going to have to do since it's a level 3 asset. And then you're also sort of putting the reader on notice that the valuation is more subjective than the higher level 1 or level 2. A couple other concepts I want to talk about. Seth talked about the difference between economic value and fair value. So I think from an accounting standpoint, it's very important to understand what the difference between those two are and what your spread is, because you're going to book your MSR initially at fair value. So if your fair value is 120 basis points, but the economic value to you based on your actual cost of service is only 100 basis points, you got a spread of 20 basis points in between your fair value and your economic value, and that 20 basis points is going to come back to you negatively and run through your income statement over the life of that servicing asset. So the return you're going to get is that economic value, not the fair value. So that inefficiency, that 20 basis points inefficiency, that's going to come back and lower your returns over the life of that servicing asset. So I think it's really important to understand that concept between fair value and economic value, and to know what the difference between those two values are. Likewise, a concept that's difficult to understand is you're capitalizing most of the value of the MSR when you capitalize it initially. So you've captured most of the value of the MSR at the initial point, and the only piece you really haven't captured is the discount rate that you have inputted into your model. So for example, if you have a 12% discount rate, that's really what's going to be your return after that initial recording of fair value, assuming interest rates don't change or none of your other assumptions change. So and that's an important concept to understand as far as how you're recognizing value on that asset between initially and then over the life of the servicing asset thereafter. Lower cost or fair value. So after you're initially recorded at fair value, now you have a decision to make, because you can subsequently record that asset either at fair value or amortized costs. And there's sort of pros and cons to both of them that we're going to walk through. So amortized cost, obviously you're going to have a more conservative balance sheet valuation. It's going to be less volatile to the income statement because it's going to tend to smooth out earnings. Your amortization expense is going to track with your net servicing revenue that you're recognizing, so there's probably a better matching of revenue and expense. So that's a consideration. And the cons are it's more of an administrative burden. You have to go through and calculate the amortization expense. It's not as easy as you're doing a fixed asset and just doing a straight line 7-year life. You're really going to amortize it proportionate to your servicing revenue, net servicing revenue, to your future net servicing revenue. So that's not a real easy calculation to do on a monthly basis, and you almost need a model to be able to do that. Going to fair value, the advantages is it's going to have the highest balance sheet valuation, and therefore you're going to be probably closer to what the true economic or market value of the asset is going to be reflected on your balance sheet. You're going to have greater volatility on the income statement. So, as the market goes up and down and interest rates go up and down, your fair value is going to fluctuate up and down, and you're going to capture those fair value changes on your income statement. So if you hit an end of the quarter and there's a bunch of market movement downward at the end of the quarter, you may have a significant hit to your income statement by marking your portfolio down to fair value. From an administrative standpoint, from an accounting standpoint, it's relatively easy. All you're really doing is getting a valuation on a monthly, quarterly basis, whatever you're using, and just booking an entry to adjust your asset to the fair value amount. So from that standpoint, the accounting is much easier than trying to go through and calculate amortization and impairment and things like that you have to do under the low-com method. And then finally, once you elect fair value, you cannot go back to the low-com method. So that's sort of a disadvantage from a fair value standpoint. So, I mean, a lot of times what we tell our clients once they're starting out is start using amortized cost. Once you get comfortable with sort of the accounting and the valuation changes, then you can make a switch to fair value. So, a lot of times that's the way to go. Start out amortized cost, wait till you get comfortable, and then move to the fair value model if you want to do that. Just realize you can only make that switch from amortized cost to fair value at the beginning of the year. So it's an accounting change election that you're making for financial reporting purposes, and that has to be done at the beginning of the year. So the next slide is just sort of a grid that sort of lays out some of those pros and cons. Just to comment on the amortized cost, to the extent it's a low-com method, so if fair value drops below your amortized cost, you have to take a impairment adjustment and record an impairment reserve. You can recapture that reserve amount to the extent the fair values recover, but you can't recover more than what the reserve amount is. So you can't write it up above what your original cost was under the low-com method. You can't have a potential for permanent write-downs. If you reach a situation where it looks like the value of your portfolio is never going to recover beyond a certain point. So you could have a permanent write-down on the low-com method. And then going over the fair value, probably something that Seth talked about when you get to a certain size, you're considering hedging your portfolio. Once you do that, if you're hedging your MSR portfolio, then it makes sense to go to the fair value accounting model. Otherwise, you're going to have a one-sided, your hedge is going to go up and down, and unless you're using fair value, you're not really matching values with the hedge value. So if you do start hedging, then it really makes sense to use fair value. Otherwise, it's really sort of evaluate the pros and cons and decide which one you want to use. Stratification, you're required to stratify for financial reporting purposes as well as making determinations as far as impairment. So, probably a good starting point is, your third-party evaluation reports, the tranches that they're breaking everything down by and valuing. So you can stratify by interest rate, by loan type, Fannie Mae, Ginnie Mae, Freddie Mac, loan size, origination date. Seth talked about an age portfolio as opposed to a new portfolio. You can do it by term, product, geographical. So those are all different characteristics that you might want to stratify your portfolio by. We're seeing a lot of stratification by interest rate right now. So you might have, three different tranches, one for below 4% interest rate, one for 4 to 5, and then another one, everything over 5%. So from a financial reporting standpoint, if you're doing low-com and you're using the tranches for your impairment, there is some advantages to having fewer tranches because then you're more apt to recover the entire reserve, whereas if you're doing, a lot more tranches, your ability to recover is sort of dependent on the characteristics of that individual tranche. Tax considerations. So MSRs have a great tax advantage, especially if you're originating and retaining mortgage servicing. So to the extent you're only retaining normal servicing, you're sort of getting the best of both worlds. So from a GAAP standpoint, you're booking the fair value of the MSRs at the point where you retain them. But from a tax standpoint, you're not recognizing any of that income from as taxable income. So, the MSRs have zero taxable basis. Likewise, you don't get a deduction for the amortization expense, and you're only really booking taxable income as you collect the servicing fees. So, there's a great tax advantage there to where, you're going to have a big book tax difference if you're retaining a significant amount of OSMRs. Excess servicing, I'm not going to go into a lot of detail. Seth talked a little bit about excess servicing. Just realize you're going to have to capitalize the excess servicing for tax purposes. It's similar to an IO strip, where you're going to amortize using the original issue discount rules under the IRS guidelines. I threw in a couple of the IRS Rev Procs if you want to go look at some of the tax literature as it relates to mortgage servicing rights. And then one comment regarding purchase servicing. The tax advantage if you're going out and doing bulk acquisitions of servicing is not quite as good. You're going to have to amortize on a straight line basis over 9 years. So if you're looking at a portfolio right now that really has a 6 or 7 year life, the IRS is forcing you into just a 9-year amortization life on a straight line basis. So, if you're doing a combination of purchasing servicing and originating servicing, just realize there's a different tax treatment there. And then finally, just some materiality considerations. I get this question a lot as people start adding an MSR portfolio to their financial statements. It's like, okay, how much time are you going to spend on the MSR, and how important is it to get a valuation on it, and how often? And a lot of that comes down to how significant the portfolio is to your financial statements. So, and I just gave you some guidelines that we use as auditors as to what materiality would be. And I mean, just realize, if the MSR portfolio is 5% of your total assets, we're going to spend a lot less time with looking at the valuation and the input assumptions and doing all the testing than, if the MSR portfolio is 50, 60% of your total assets. So, and with that, I'm going to turn it over to Seth, and he's going to jump into some business factors.
All right, thank you. We'll spend a little bit of time, as I talked about earlier, talking about an effective MSR hedging policy. And one thing that I want to raise here for any bank holding companies, and it's a discussion we can have offline, but if you are a bank holding company and are going to be subject to Basel III, one of the things you need to be aware of is that there is a different capital treatment potentially between being under fair value or low-com, and that's something I'm happy to have individual conversations with offline for folks. But let's talk in general about a hedging policy. And Keith did a great job of sort of highlighting what they're looking for an audit perspective. I would advise people along similar lines with one caveat. If the change in the MSR asset is something that's going to get you fired, I'd certainly consider hedging it. So that'd be my one caveat to materiality, because audit materiality and job materiality might be two different concepts at times. But effective hedge policy, you're going to want to define it up front. What risk are you looking at? What tolerances are you looking at? And then off of a shock profile, which is shocking the MSR asset for changing in interest rates, you're going to want to layer in the appropriate amount of hedge coverage. I would suggest a smaller band than we typically would look at from a shock perspective, 25, 50 basis points, potentially 100 basis points, and having risk tolerances set up around those limits. There are several firms, again, Steve and I can recommend, that are experts in the hedging field. I don't want anyone to walk away from this conversation. I am not an MSR hedger. I am the valuation side of this transaction. The valuation and the hedge side need to be different. They should have different sets of controls, different reporting structure. But I could certainly recommend, and Stephen can recommend, firms that we would recommend for hedging the MSR asset. But one kind of caveat off this page is Hedging may be profitable at certain times, i.e. there might be some carry you can earn on a hedge, but over the long period of time, hedging should be a net cost, and it will actually reduce the yield of the MSR asset. It will lock in that yield, but it should be a lower yield. So hedging is not for free, even though at certain periods and certain cycles you can make a little bit of money on hedging the MSR asset because of some carry components, or it might be positively convex at certain times. I think, Keith, you're up next.
Okay. Yeah, another business factor, and probably one of the most significant to the independent mortgage bankers, is just some of the cash flow considerations. You know, you have limited capital, you have limited cash, and you're trying to maximize your returns. So I think it's really important that you have a model to forecast the operational impact of retaining servicing. Like I said, you're trying to maximize your return on limited capital. So without some sort of model that can help you sort of model your cash flows and your returns, I don't think you're going to maximize your returns. So I think that's important to take into account. You know, if you're just getting into retaining, you know, just realize there's going to be some cash drain to the extent that, you know, you're having to do servicing advances for P&I, advances on foreclosure costs. So just realize, you know, there's some additional cash considerations that you have to take into account. You know, realize the market is still illiquid, although it's starting to come back. So, you know, don't assume you're going to be able to sell your portfolio and come out whole. You know, if you run into a liquidity crunch and are having to do a bulk sale of your portfolio, you know, to, you know, cover a liquidity problem. You know, you have the question as to, you know, are you going to go the subservicer route, or are you going to build a servicing platform? You know, and at some point there's probably a critical mass where it makes sense to move off a subservicing type model and actually build out a servicing platform. But, you know, that's going to cost cash and capital. So you have to take that into account into your model. I mean, there's some benefits to having your own platform. You can tailor it to your needs. You're going to be closer to the customer, be able to touch them more often. You know, and I think as we see the independents build up their portfolios, we're probably going to see a run on servicing talent at some point as the independents, you know, start wanting to build out platforms and try and find, you know, some of the talent out there that can actually do them. And I think it's going to end up being a limited resource at some point in time. Future compliance and regulatory costs, just, you know, realize that those servicing fees are fixed at a certain basis points, and your costs aren't. So, you know, you're projecting out costs for, you know, 6, 7 years or whatever. Just realize, I mean, you know, if all of a sudden CFPB or somebody else comes around with some, you know, compliance costs that are overlaid on servicing, you know, your evaluations are going to take a hit to the extent your costs go up. So, you know, that really needs to be taken into account in your model. You know, and then Seth, you know, he's really on point where he said, make sure you're comparing your model to your actual cash flow, so that you're going through and adjusting your model for those things that really aren't tracking with your actuals. You know, whether it's your foreclosures or prepayment speeds or whatever. So, so I think that's really important. That's one thing I don't see our clients doing a real great job, is really sort of tracking what their actual return, you know, on their MSR portfolio is. You know, I think it's important to track it sort of in a separate profit center. You know, and a lot of times, you know, the only things we're seeing tracked is servicing fee revenue and subservicer costs. And, you know, you have other costs besides that. You know, you have compliance costs, you have people doing the boarding of the new loans onto the platform. So just make sure, you know, that you're taking into account all the costs, and really making sure you understand what your true return is, not just what you originally modeled and you know, what you had projected your internal rate of return is. Start tracking that with your true actual returns. Capital considerations sort of tied to the cash considerations. It's really important to figure out what is your strategic objectives if you're just jumping in and retaining servicing. I mean, are you retaining for the long term? Maybe it makes sense to build out a platform. Maybe you're just looking at the market disruption and jumping in, and as soon as the market returns back to normal, you're going to sell your portfolio bulk. So those are sort of two different strategic objectives that you're going to have two different plans depending on what your objective is. You need to forecast your capital requirements, and your return objectives. So, what return hurdle is acceptable on our portfolio? What percentage of the production are we going to retain? Are we going to retain everything? Are we going to cherry pick, and try and get the highest return because we have, limited capital amounts? Next question is, where are we going to get the capital to retain all our servicing? If you're going to do 100%, you may be in a negative cash position. So to be able to retain everything, you're probably looking at going outside and getting some outside money. Where is that going to come from? How much of the company are we going to have to give up as a result of that? And what does that mean to the company? So,
Pardon me, Keith?
Yeah.
Keith, this is Stephen. Yeah, I'm very happy you mentioned that, because in that context of kind of outside capital, we get a lot of questions about MSR financing, and is it debt financing, equity type structure, or other permutations thereof. And it's certainly I'd say with the trades and MSRs has realized greater participation, so better terms, better liquidity there. But it's something I would strongly recommend you speak with an outside advisor on before you just delve into it. There are a variety of shops out there, but the covenants can be sticky, as can some of the structure aspects of it. So it's there, and I think Keith and Seth and myself are more than happy to talk about that offline as well. So sorry, Keith, wanted to interject there. And also, I think we just crested the hour. I think we're fine keeping this. Is that right, Keith? Are we able to keep speaking just to round this out? I think we're making great progress so far.
Yeah, I think we're close. So we might run over a little bit, but I don't think we have much longer. So
the webinar will sustain us, right?
Yes, it will. So all those are good, considerations, and then you have Basel III, and the considerations that you're going to have to make as it relates to that. The next thing to consider is net worth considerations. So just realize, retaining MSRs, it's new to a lot of the warehouse lenders. They're used to lending on, loans held for sale that convert to cash in 15 days. They're less comfortable with MSR values. They see those values can disappear overnight. It's not a liquid asset like loans held for sale. It's difficult. It's not that easy to convert it into cash. So we're seeing a lot of covenant requirements, haircuts on valuations where they're not giving you full valuations, limitations on what percentage of your MSR is to your net worth, to where we're only giving you credit up to 50% of your net worth, and certain limitations that they're placing on the companies that are retaining servicing. So you're just jumping in, make sure you're having those conversations with your warehouse lenders. GSEs and other investors, again, just HUD has they just raised their cap to $2.5 million. Ginnie Mae, Fannie Mae, I think they've been talking about raising their equity requirements to $5 million, but haven't done so. But just realize they're making qualitative evaluations of your risk exposure, and one of the things they're looking at is what percentage of your total assets are sitting in that MSR. So they're making those considerations, and then just from an ongoing basis, last couple of years have been great from a bottom line standpoint, a cash flow standpoint. All our independent clients are able to pretty much finance the majority of their retained servicing from just cash flow they're generating from operations. But really, hopefully you have a model out there that says, in 2014, if refinances go away, our production drops 50%, what does that do to my cash flow? What does that do to my ability to retain servicing? And what am I going to do with my existing servicing if I'm in a break-even or a negative cash flow standpoint. So, those are, you can get into a liquidity problem pretty quickly. If the market turns and production drops, and you've been trying to retain 100% of your origination. So make sure you're taking those considerations into account. With that, I'll turn it over to Seth, and he's going to start on some reporting and other considerations.
And thanks, Keith. That's a great segue into, I'll sum this up, the next three slides pretty quickly, but this, again, is a governance and documentation process. Not only should you be talking about the MSR valuation, but you should be talking in light of your covenants, limits, make sure everything's documented as far as the approval. I can tell you, in my experience at SunTrust, we went from being a one-man shop who controlled all the MSR valuations, which was me, to having 8 people report to me having to report to various committees. It did at times have involved us having to go to see our parent and our CFO to explain certain results. But it is something that's, get into the cadence of having clean governance and documentation structures and policies. And that's something I could certainly offer some insight on as to my past experience about what worked and didn't work. You want to make sure you've got good systems in place to track the profitability of servicing, which goes back to Keith's point about cash flows. Understand the return of this asset. You need to understand it internally. You need to understand your assumptions. You need to understand the risks. Oversight, even if you're in a sub-servicing arrangement, it does not absolve you from oversight and monitoring of that sub-servicing arrangement and the contract you've got with them. All assumptions need to be approved by senior management and or committee, documented, and that any changes should be clearly tested, approved. That's one of the things that the auditors are always going to come in and look at, I would assume, is assumption change. What was your assumption, your profile before the change and after the change? Make sure that you've got clean monthly reporting that clearly highlights the risks of the MSR portfolio, and if you're doing hedging of this asset, make sure that management's aware of the risks of hedging, because sometimes we hear senior management hears hedging and they think it's a risk-free event. No, there can be a disconnection between the hedge instruments and the MSR asset from time to time, and that needs to be kind of clearly communicated up front. Finally, regulatory considerations. I won't spend a lot of time here. Unless you're a bank holding company, my understanding is Basel III probably doesn't have a big direct impact to you, but it certainly can have an impact if you are selling to an aggregator. And that can be a whole game changer if Basel III all of a sudden causes warehouse lenders and or aggregators of servicing to change. So it's something that you want to be aware of, even if it doesn't impact you directly. And again, that's something that Steve and myself are more than happy to take a conversation offline on Basel III. I was in Washington, D.C. talking to the auditors and regulators with the MBA in early December, so I'm pretty versed on mortgage servicing rights and Basel III. CFPB, what does it mean for servicing? What does it mean for servicing expense? What does it mean for your servicing operations? All considerations that you either have to make sure your sub-servicer is compliant with or that you are going to be compliant with. And other political, there's all sorts of random events that can occur. HARP 2 is probably the most recent example of something to talk about, where all of a sudden a bunch of borrowers that traditionally could not refinance all of a sudden could refinance. Had a big impact on bonds, had a big impact on servicers, had a big impact on originations. In fact, had a big impact on profitability in 2012 and 2013 for mortgage companies. So always be aware of what's going on in Washington, D.C. And I think that's it. The last page just has our contact information. As we've said at the beginning of the call, unfortunately we don't have time for questions today, but here's our contact information. We are more than happy to answer any questions, expand on any of these topics. As I alluded to, I could spend 3 hours on some of these slides, as I'm sure Keith could. So this is a very high-level overview, but we'll be happy to answer any questions that anyone on the call would have.
Hey Seth, if anybody wants to stay on the line, there's a couple questions that came up on the screen, and if you have, maybe we can answer a couple of those. Any of the attendees that need to jump off the call, that's fine. A couple of questions about can you email me a copy of the slides? So yeah, if you send either myself or Stephen an email, we'll be glad to send you a copy of the slide set.
Absolutely.
So we're also taping this, so we'll have the have it up on our website in a day or so. So our website's www.richiemay.com. So it'll be on a website. So if you know of anybody that missed it, we'll have both the audio and the slide deck combined together. So if they want to watch it again, or if you want to watch it again, it'll be up there. So there's another question about what's sort of the critical mass to move away from a sub-servicer to an internal servicing platform.
I could take a swag at that, Keith, if you want, and then let me go first, because then Seth will correct me.
I'm kicking you under the table. No, just kidding.
Does that sound good?
Yeah.
So for critical mass, that's a good question. I can't see you pose it, but that's certainly an appropriate one. We've encountered that quite a bit over the past, especially the past 12 months on that. It's safe to say this: there is no magic number, but the magic number that we've heard in the past, and I'd infer that the individual who posed this question may have also have heard this as well, but it was $1 billion. Meaning, if you had over $1 billion, that therefore denoted critical mass. That therefore justified the cost, expenses, compliance, oversight, et cetera, of sustaining your own internal servicing platform. What we've sort of informally discussed here, and actually I'd really be curious to see Seth's comments coming so freshly from SunTrust, is that if it was $1 billion, and again, caveat, there is no magic number, if it was $1 billion, whatever it is today is higher. So maybe that's $5 billion now, because with the amount of oversight, with the variety of OCC compliance, the variety of CFPB new doctrines that need to be followed out there, this asset, I think Keith put it well before, the annuity revenue aspect as it's currently arranged is fixed from the fee. There, of course, are ancillary income aspects too. But that cost can be changed. It could be changed on the dime. And I think even the CFPB just in the past few weeks unveiled something that impacts what we do quite a bit, which is on these servicing trades, making sure that the buyer not just, of course, can dutifully fulfill and has the approvals to do so initially, but on an ongoing basis that will be tracked. So I think that policies, procedures, the QC, the oversight has greatly pushed that out, from whatever it was. So there is a magic number, but using monopoly funny money, if it was $1 billion, we would say it has to be higher than that right now, and we've kicked around 5. But again, there's no real number. And on the caveat, just keep in mind that number is not just a function of the cost of the asset, but the subservicers in those contracts, and those contracts can vary widely. We work with all of them out there. They all do a good job. We can speak offline about helping you select one. But the contracts as well can vary, so the economics are really going to be a function of what both sides of that P&L, I guess, render and dictate. And I'll stop there if Seth wants to jump in or correct me here.
No, I'd echo those comments. The only piece I would add is that I'm a cash flow modeling for the last 17 years, so to me it all falls down to the economics. And it's going to fall down to the economics from, CFPB I think has a small servicer exception that if you're under 5,000 units, you may not be subject to everything that's in CFPB. So I think there's some critical elements there that need to be considered before jumping both feet into a servicing operation. That being said, it would be my strong advice if this was an area that was going to be a long-term part of your business strategy, I would certainly be willing to take a slightly lower yield today to build out my own servicing platform, because that will benefit me when I get to that critical mass. That being said, if I'm somebody who I feel, if my business strategy is I'm certainly going to be more transitory in the servicing, where I might be a holder for a year or 2 or 3, but I don't think it's core to my business, I would be much more interested in negotiating that sub-servicing arrangement and understanding those economics, but trying to drive the best economics out of that sub-servicing that I could.
All right, here's another question. What are some appropriate hedging strategies? We could probably spend a couple hours on hedging strategies. If you want to shoot me an email, I can put you in touch with some companies that hedge MSRs, and I'm sure they'd be glad to spend some time with you. It's not as easy as hedging your loan pipeline. It's a little bit more difficult, but I mean, the MSR portfolio does move in line with interest rates, so there are strategies to hedge the MSR portfolio and do it effectively. As Seth said, there's cost to that also, so it's important to understand, what sort of cost benefit and, what sort of size portfolio do you have to make that make sense.
If they want to contact me, I could walk them through as detailed as they want the strategy that we employed at SunTrust to actually transition ourselves from a global macro hedge using Treasury balance sheet instruments to a micro MSR active daily using swaps, TBAs, and swaptions strategy as well, and sort of the pros and cons. And it's quite a process to go through, but I'd be happy. I mean, that's probably a more detailed conversation than for this group. But if whoever asked that question, if they want to shoot me an email or give me a call, I'd be happy to walk them through what we did, what we learned, what we did well, and well, we didn't really do a lot bad, but what we did well.
Okay, another one. In what states, specifically Texas, can I earn interest off of the escrows? Where could I find this information?
Well, call Stephen. No, the ability of a company to earn interest on escrows depends on what their structure is. For a bank like SunTrust, it was very easy to convince the powers to be that the escrow funds were sticky and that I deserved a good internal rate. If you're a warehouse lender, those escrow funds or a mortgage banker, those warehouse funds might be better served paying down a warehouse line. Yeah. Interest on escrow, we could certainly get you, where states where we have to pay interest on escrow, we could certainly get you hooked up with our analytics area here where they know the 11 states, which are predominantly the Northeast and the Northwest, where you have to pay interest on escrow, and actually talk through sort of the multiples that we use from a valuation perspective for escrows. And it is county specific, but we could certainly provide some guidance as to state level escrows analysis.
All right, two more questions, and then we probably need to jump off. What are the average costs for subservicing? So what are you guys using for your fair value models for subservicing costs?
Well, I'll answer first, and then Stephen can kick me under the table. It's going to be a range. It's going to be a range based on product and delinquency. So whatever numbers and volume. So whatever numbers we give have to be caveated that it's a volume play from the subservicer. It's product specific and it's delinquency specific. But let's just talk currents in general. I think we would see something in the range of $6 to potentially $9 a month for currents, and it's going to be incrementally higher for 30 days.
Per loan, right?
Per loan per month.
And then that will ratchet up 60, 90, 120, bankruptcy, foreclosure, and those. And as to Seth's point, and it would also be a range, but it would vary based on the product and profile mix.
And what percentage of the ancillary fees, like late fees and stuff like that, would you?
Again, negotiable per each servicing contract, subservicing contract. Sometimes it may reside with the subservicer. Sometimes it may reside with the holder of the MSR. Again, it's going to be a volume play. You might be able to get a lower cost per month, but they keep the flow in ancillary. It all depends on how you want to structure the deal. It's all negotiable.
And yeah, we're more than happy to get into greater detail with that with anybody offline, because it is negotiable and it does vary case by case. Oh, and actually, I think there was a corollary question there about what do we use for the fair value then. So, I mean, the fair value assumptions, I think, also have some general leniency there, but it would be the market understood fair value, which I think correlates to like how would the top 20 or the more, say seasoned, but the more liquid banks present or portray the performance of their MSRs, both from the cost and then the revenue side. But I guess the cost here is what we're talking about. Is that fair?
Yeah, that's fair.
Okay, and then finally, what are some of the, what are some of the input assumptions that can sort of change on a dime and impact your valuation?
That's perfect for Seth.
All right. Well, Clearly interest rates, whatever your interest rate model / assumptions, how you're constructing mortgage rates in your model, and it could be as simple as using the FNCL from Bloomberg. It can be a lot more complicated than that. But clearly, an assumption that's going to change in the dime is interest rates. Interest rates are going to drive, at a minimum, prepayment speeds, which is the most important assumption. And depending on how you're modeling your MSRs, you may have tied to the same interest rate changes, discount rate and float incomes, which would pretty much make up the bulk of your sort of huge assumptions that could change. On a dime, I would say interest rates. What tends to be a trend tends to be more servicing costs or ancillary.
Okay. We're actually not losing many attendees. I think everybody wants to just stay on all afternoon. But
I talk MSRs.
Well, yeah, talk for an hour or so. But I think we probably need to end it there. Cindy, do you want to wrap up for us?
Yeah, no, happy to. Just so thank you everyone again for the time spent with us this afternoon. More than happy to address any questions. If you have some immediate ones, give us a buzz or an email this afternoon, or as it kind of arise throughout the weeks ahead. Phoenix Capital will also be in New York next week for the upcoming secondary conference. I know schedules are pretty tight right now, but we have a good amount of coverage there. So happy to meet in person if the calendar and the interest permits that next week. I would love to meet anybody in person if available. And beyond that,
Likewise, we'll be at the secondary marketing also. So
I was about to say, okay, good. Then the same goes for Keith and the Richie May team as well. And so beyond that, thank you very much again for your time, and best of luck on this asset, and looking forward to speaking soon.
Great. Thanks, everyone.